and welcome once again to the Up Your Assets podcast. I'm your host, Ray Ferrara, CFP, and I'm the founder and executive chair of Provise Management Group, LLC, which is an SEC-registered investment advisor with approximately $2.1 billion of assets under management as of June 30th, 2026. Provise serves about 1,200 clients in over 30 states with offices in Clearwater and Tampa, Florida. One of the major tenets of investing is diversification. Simply said, you don't want all your eggs in one basket. For anyone investing on behalf of clients, they will have a mixture of stocks, large, mid, small, growth, value. Bonds, they'll have government, corporate, high yield, taxable, tax-free, and lastly, cash. But sometimes you want to diversify even further by adding alternatives like private equity, private credit, hedge funds, real estate, commodities, and maybe even crypto, although you know we're not big fans of crypto. There are many other ways to look at diversification. Another alternative, which we're going to discuss today, is investing in tax liens and tax deeds. Now, let me be the first to say this is definitely not for everyone, but for a few, it might be something to pique your interest. I would classify tax lien and deeds as a high-risk, but potentially high-return alternative real estate strategy. You need to do your homework, and you need to do it well. I personally have never done this, but I've always been interested in it, and I hope you will be as well after you view the podcast. As you know, we do not endorse any products or services to our audience, and no one pays us to be on the podcast. All of this is for information and educational purposes only. To help us unpack this unique investment opportunity is Brian Seidensticker, the founder and CEO of Tax Sale Resources, who, along with his sister Rachel, have a combined 20-plus years of real estate and distressed property experience. This duo have some great tips and insights to help investors get started in tax sale investing, or, at a minimum, to understand what this investment is all about. Brian, welcome to Up Your Assets podcast.
Thanks, Ray. Thanks for having me.
Well,
glad to be here.
It's great to have you here, and a lot to do in the short time we're going to be together. And I think the best thing to do is kind of start with the most basic approach that we can. So for listeners who are unfamiliar with the concept of tax sales, how does the market work? And where do investors typically earn their returns?
Well, I guess a little background so those listening can, I guess, maybe have some faith that I do know what I'm talking about. I've been in this space for almost 20 years, and I'm on the board of the only nonprofit association in the space called the National Taxing Association. And I maybe should have, Ray, put CTLP acronym next to my name, but most people would look at that going, what the heck does that mean? Because it really isn't a designation that is out there, but it stands for Certified Taxing Professional. And it's I guess I'm one of maybe 40 people in the country that have been certified by the National Taxing Association. So anyway, long story short, I've done some time in this space. I'm certainly not the smartest person in this space by any means. Just want to talk about some real information. So, great question, right? Where do investors typically get the returns? I think it helps a little bit if I describe how a tax lien works, and because there's really two places that you can make a decent return, and they're very different as far as approaches. Starting with, what the heck is a tax lien, right? Most people don't really think about it because most people pay their property taxes. But the question really bears what happens if somebody doesn't pay their property taxes? And most people haven't even thought of that, right? And there's really a deal that's made essentially and started many years ago between the county or the jurisdiction that's collecting the property taxes and a private investor, right? And the deal essentially goes like this. It says, hey, I need to balance my budget. This is the county. And if it's one person that hasn't paid their property taxes, not a big deal. But the largest, usually the largest tax sale in the country, which is Cook County, can be a couple $100 million, right? It's a significant amount. And that's a lot of teachers that you could pay. That's a lot of policemen, a lot of roads you can pave. And so they make these deals with private investors that says, hey, I'm short $200 million. If you can help balance my budget, right? When the homeowner pays their property taxes, and 99.9% of them eventually do, whatever penalty that is applied to that payment, I'll give to you, right, as the private investor. That's your return. And then on top of that, right, if they never pay their property taxes, I'm going to put a lien on their house, similar to mortgage, and you would be allowed to start a foreclosure on that property, just like a mortgage foreclosure, right? So you're secured by the asset in the long run. And that process is called the tax lien, right? And so private investors can come in and buy those tax liens, usually individually, right? One by one through an auction. Some states, they host it really the whole county at the time, right? So it's, really for institutional investors only. But you're a investor in paper at that point. You're not investing in, you don't own the real estate. You're never going to own the real estate buying the lien anymore. You are kind of a micro mortgage investor at that point. On the other end of that process, right, I mentioned the foreclosure that can happen if the property owner never pays their property taxes. Again, very similar to mortgage, right? It's usually done by a judicial process, right, or sometimes it's done by the county, right, administrative process. But culminates in an auction of the property, right, to basically sell the property. Now investors are buying the asset, right, and they're gonna, just like any other real estate investor, do what they need to in order to get a return out of that. And the proceeds from that auction first go to pay the previous investor, the lien investor, so they get their return at that point. And then whatever excess remains can go to other lien holders, the mortgage holder, if there is one. And then eventually, if there's anything left over, gets returned back to the homeowner, right, through a process. And that all varies. That whole process, varies a bit state by state, but that would be kind of a vanilla flavored version of how the tax lien process works. So long answer, but there's really two ways you can invest in this, right? You can buy the lien. It's much more, I'll say, passive. You still have to be actively engaged in doing it, but you're not owning that real estate. You're not getting the code violations. You're not getting all of those things like you would if you're the real estate owner, which is the tax deed buyer. Now you're a real estate investor, just like any real estate investor. The return comes with the same risks and the same headache, right? Depending on how involved you want to be. So that's really the long story short on how the tax liens work and where you can make money on those two ends of the spectrum, right?
So, couple of things. As you mentioned, the order in which people got repaid.
Mm-hmm.
I noticed that the tax lien got paid even in front of the mortgage holder. Is that correct?
That is correct. And well, in most states, right? There's really only one state that I can think of, right? But states are constantly changing their statutes. But New Mexico is the only one where that doesn't necessarily hold. And then there's states with multiple different processes. So Pennsylvania, for example, has a couple different sales. One where you are not superior to the mortgage, and the second one where you are, right? So you definitely got to look it up to see in your state. But in general, most states out there, when you buy a tax lien, you are in what they call super majority position. You're in front of any mortgage at that. So it's a little more secure position than a mortgage.
So you mentioned a tax lien in the beginning. Then when the person pays, and about 99.9, I think you said, percent actually do pay their taxes. But if they don't, what's the period of time before you can go to court to start foreclosure? It probably varies by state, but kind of what's a general time frame?
I'll correct my stat there just for anybody that's going to go with AI these days. You gotta, it actually, I think it's like 99.7% of delinquent taxpayers do. It's not quite 99.9. Anyway, those that are listening going, well, he's wrong. It is a little less than that, but it's the vast majority.
You weren't wrong. I was wrong.
Well, I mentioned that. And I guess in that sidetrack, what was the question again, Ray?
The question is generally from the time you buy the tax lien,
yes,
how long? And as I say, I'm sure it varies by state, but kind of generally, you have to wait a year before you can foreclose on the property. 6 months, 3 years. What? Just kind of a broad spectrum to look at.
Yeah, you nailed it. It varies by state, and it does run as little as 3 to 6 months on up to multiple years, right? And then there's the minimum line time you can wait, right? So I'll just use Florida, for example. You have to wait at least 22 months before you can start that process, and you have to do it within 7 years, right? So there is a time frame in most states where you need to get it done. It doesn't just last forever.
So help us understand, Brian, what's the difference between a tax lien, a tax deed, and what are the pros and cons of each of those from an investing point of view?
Yeah, and I think it's since I kind of covered, the tax lien is really the you're buying a security, right? In that real estate, you're not buying the real estate itself. and then the deed, you're actually buying the real estate. The pros and cons are really, come from what position you're in, right? So if you're buying the tax lien, again, the pros are you don't have the same level of headaches of owning the real estate, right? You're typically into that investment, a few percent of the overall value. So you're, pretty well, collateralized in that instance. There's actually many banks out there that have gotten comfortable with the tax lien. So if you're looking to do it at scale at an institutional level, right? There's banks that you can work with to help you, scale from that perspective. Now, cons of the tax lien world is there is competition on that side, right? There's a lot of not misinformation, but I think wrong expectations from folks that get into the space, because if you go read online, you'll find that, yeah, you can make 18, 20, 24% buying tax liens in theory, right? But the competition at these auctions and the way they occur suppress that, right? And so especially if you're going to do this at scale, right? We're talking 6, 7, 8% maybe, right, at scale. And then it becomes a game of like, what's my lowest cost of capital? Like, how do I make that, spread, that arbitrage spread in the middle? On the other end of the spectrum, the tax deed, right? You're a real estate investor. The vast majority of tax deed investors are local folks that have learned how this mechanism works. They go to the local auction, and they're the fix and flippers, right? I haven't figured out how to prove this, but if anybody's watched HGTV, shows, fix and flip, flip and flop, all those, shows where they walk in at the beginning of the show and it is, I say, a hoarder's paradise. There's stuff everywhere. It looks disgusting, right? And then at the end of that show, it's the nicest house on the street. I guarantee there's some of those at least that were tax deed foreclosures. That's the type of asset that you're buying. And so there's, the cons are you get all the headaches that come along with that. And I can tell many, many stories that go down that rabbit hole. But the pros are, if you do it right, you're not limited on the return. You can make a great return, right, if you buy right, just in like any other real estate. And on top of that, I guess, and this is my opinion, vast majority of the time, you are not only benefiting yourself, right, in the return that you get buying that real estate, but you're taking a eyesore, right? It's usually the dilapidated house on the corner that nobody wants to go inside, that is attracting squatters and that sort of thing, and you're turning it into the nicest house on the street, and you really do raise the values of every house around you, and really the attitude of the neighborhood when you take that project on. And so it's highly gratifying, right? There's I guess side benefit from just monetary standpoint of what the way you feel after you do that project. So very different investment mentality, very different return profiles, very different risk profiles, but that's to touch on some of those, right?
So Brian, you are really in a unique industry. Obviously more complicated than we can get into here on the podcast. But from the time you started to kind of where you are now, how's your investment approach evolved over time?
Well, today, right? Well, I guess I'm always good at stories. When I first learned of a tax lien, I say regularly, it was on the wrong side of a tax lien. I was doing the standard fix and flip thing as a side gig. I was an aerospace engineer in my previous life. And I was upside down on a property in 2007, 2008, and had a bunch of tax lien notices sent to me, right, on a property. Had never even heard of what this whole industry was all about. And that's what started, down that path of investigating, realizing, wow, many years later, but wow, it's, an $8-9 billion a year industry. It's not tiny, right? It's just unknown. And started buying tax liens originally. And that journey really led to creating some internal software to answer basic questions of when and where these sales are occurring, what properties were in these sales. None of that existed, right, like it does today. We created a platform where investors can go look that stuff up, and within a couple of years, basically abandoned the whole fund strategy because the software took off. Because I was number one in an ocean of nobody else, competing. It was a great position to be in. That further evolved into really 8-9 years later, 2018, 2019. Initially trying to investigate how to provide capital to tax deed investors, because we realized most of them are cash limited. How do we get a bank involved? And eventually the bank liked the model, didn't like, necessarily the position that they were being put in, regulatory speaking, because it's this gray area between a security and and real estate. And so they said no, and that was the first time that we looked at maybe buying tax deeds and have significantly scaled that. And so today we're still, I believe, the largest provider of data and software in the space. And then we do invest in tax deeds. So it's been a journey, one that most people I talk to go, "What? Why would you ever get in that space?" But it's been an amazing journey for me and very fun. And every day's a new adventure.
Well, so I know you have a fund that people can invest into, and obviously, as we've talked about, there are some risks that are involved in this, there is with any investment. So, how do you determine if it's a suitable investment for a potential investor?
Well, the biggest thing that we focus is on the deed side, right? The return is higher, right, but the risk is higher too, right? And the number one thing that we are doing is underwriting that asset, right, and then also determining which ones are going to make it to the auction. And that's kind of an I'd say unanalyzed typically piece of the space is you can research a ton of properties in an auction, and most of them redeem before the auction ever takes place. And so you end up wasting a lot of time, effort, ultimately, cash on underwriting right properties that never even have the option or to bid on. And that's one of the first things that we've done, through analytics, is to help determine which ones are actually going to likely make it to the auction, so that we're not wasting time underwriting properties that never do. That's one of the unique things that we do. Another unique thing beyond, I mean, obviously we're underwriting the asset itself. What is it worth, right? Which is usually a combination of here's what it could be worth, right? When it's in a repaired state, that's fairly easy. But then you got to figure out what's the reduction in value due to the estimated costs involved to get it to that state, right? And then we want to buy it at a discount to that. That's fairly straightforward. But the other side of underwriting that asset is from a title perspective, right? You don't get title insurance from any of these counties when you buy it, right? You're not closing through a title company. That's why you can't get bank financing to buy these. And there's a risk there because there could be, the lien was in first position, but there could be other, we call garbage on that title, right? Municipal liens, weird, IRS liens. There's some weird things that nobody ever thinks of. And if there's one piece of real estate or real estate industry that absolutely loves title insurance, because I know it's somewhat under attack. People don't know why I'm buying title insurance, but I tell you what, in our space, it is a big deal because they get rid of all that garbage, right? And so how do you underwrite a property and all the title aspects so that you're not buying those with hidden, garbage and ultimately costs, right? That can turn your investment upside down. So those are the biggest things that we're looking at.
So it's not quite as simple as it seems, is it?
No, it's very gratifying, but it's definitely not easy.
So what makes tax sale investing fundamentally different from just, say, traditional real estate, private credit, or distressed debt investing?
Ooh, well, it's actually tax lien side of it is very similar to like a distressed debt scenario, right? Actually, I'd say it's even more secured than typical, distressed debt scenario, because you do have that superior position versus a lot of debt is like, how am I going to recover this, right? You've got all the documentation, but ultimately it comes down to how do I recover this, and is if you're going to squeeze a rock, you're not going to get much water out of it, right? So there's a lot more involved versus it's a little easier with tax liens to like, is there value in that asset at the end of the day, right? Am I in that superior position? Is it worth moving forward? So it's a little easier, right, from that perspective. But you are, dealing with the real estate side of it. And so a lot of, private credit distress, it's a paper investing, right? And it's a very different underwriting style than real estate. And so you definitely need to make that transition of understanding not only the paper side of it, but also the real estate side of it. But tax liens, I'd say, are very close. Now, the deed side of it is real estate investing. So it's entirely different than any of those asset classes, with some added complexity from a title, standpoint.
Sure. Wow. So what are the most common misconceptions investors have about tax liens, deeds, and tax foreclosure properties?
Well, I think, I mentioned one of them, previously on the tax deed side, but it's hey, this is no different than buying any other real estate. And it's not, right? There's a lot of extra work that goes into the underwriting. And then there's the title aspect that most real estate investors don't really think about because they know it'll get worked out in the title company. And so if there's garbage there, they'll figure it out. And always gives me a right to back away from that investment. With tax deeds, you don't get that luxury. The lien side of it, I think probably number one is you can hear, I'll say, infomercials or information out there of I'm going to make 18, 19, 20, 24, 36%, right? And in theory, there is the possibility of making that on occasion, right? I guess statutorily you can make it. So it's not wrong, but the expectation that you're going to do that over and over and over, or at scale is not a realistic expectation. And so it's just going into it with realistic expectations, right? You can place, maybe a couple $100,000 buying, say mid-teens, over the counter tax liens, right? If you underwrite them correctly in Florida, you could do that, but you're not going to place 5 million doing that in Florida. You're certainly not going to do that, at a $10 to $100 million scale by any means. And so it's just going in there with realistic expectations.
So when you go to one of these auctions, and given the high returns that are possible, and let's say the tax that's owed is $3,000, it would seem that you'd want to buy it for as little as possible. But it would seem to me with those high returns, they might come down because some people would be willing to pay more than the $3,000 for that lien.
Yeah, and you're hitting on I'll say a slightly different question, which is how do these sales actually occur? Because your scenario does work that way. There are counties and states really where the process is, well, here's the amount of taxes, $3,000. That's the starting bid. Who wants to bid more than that, right? And somebody says, well, I'll bid $5 more. I'll bid 100, right? And then at what point does that return that 18%? You might be earning that, but you're only earning that on the 3,000. So you've got this sunk cost you got to figure out. But that's only one type of auction, right? Actually, the more popular auction type is what's called a bid down method, right? And so they say, hey, the lien is $3,000, right? Opening bid is 18%, right? That's what you're going to make. But the next guy goes, I want to make 17 and a half. I want to make 15. I want to make 10. Huh. Pretty soon you're down to, somebody says, I'll take 7, right? I can get my money at 5. I'll make the 2% spread, right? So it's a bid down in the interest rate that you're going to return. And both those methods, they have different calculations, but they're both suppressing your overall return. And that is exactly what happens. And that's why you don't get those statutory maximum rates at scale.
Right. Wow. So you're both a service provider and an investor. You've talked a little bit about software. So how do you use the data and the technology to improve the underwriting and identifying the opportunities in the first place?
Well, in today's world with the AI, there's so many different ways of using technology. When we started in this space, and still the unique thing that we do is compile it all, right? Where we track almost 9,000 auctions a year, ends up being about 1.5 to 2 million different parcels on an annual basis, and just having all of that data, right, and all of the data points on each one of those properties, like how many bedrooms, how many bathrooms, right? What's the county market value, right? Does it have a mortgage? Does it not have a mortgage? Does it have environmental issues, right? Compiling that all into one big database gives you a lot of opportunity. Now, how you want to slice and dice that data is up to that investor, right? They might have a secret, they may not, right? Everybody has their secret sauce, but our secret sauce, if you want to call that, is just having the information itself. And I like to think we play well in the sandbox because we very well could just say, hey, that's our data, right? Don't let anybody see it. But I don't think that ultimately benefits the industry or the country as a whole. And so we think it's way better just to make it available. The sandbox is plenty big. We're never going to be buying $9 billion of this on an annual basis. Let people benefit, right, from this, everywhere. So we like to think we play our part in the overall success of the space.
So am I understanding that you make your software available to potential investors? Is that what I'm hearing you say?
Exactly, right. You can through the website, right, taxsaleresources.com, you can go sign up and take advantage of that data like we would. What we do is just compile it in one place in a standardized format that makes it easy to apply whatever criteria you might have as an investor.
Cool. So what does a successful tax sale portfolio look like from a money manager's perspective in terms of diversification, expected duration, liquidity, and You've talked a little bit about return, but maybe a little bit more on the return profile.
Well, that really kind of depends on what size of a fund or portfolio you wanting to manage, right? And I'll maybe two larger pieces of the pie, right? One is if you're managing less than, let's say, $100,000 in tax liens, you can buy tax liens in several states and realistically make low to mid teens if you underwrite correctly. And so your expectation should be in that low teens if you're doing it at a small scale. And if you aren't right making that, then you probably can utilize resources. Whether it's we have a ton of free information on our website. Don't even have to be a member, or AI these days has a ton of that information. Like you can find other states, other ways of making that low to mid teens return on a smaller portfolio. Now, if your plan is to do this at a massive scale, right? There's funds out there that are several $100 million, right? They're very large. Now your expectations need to be suppressed, right? Not only do you have you know expenses, right? Operational expenses that you got to account for, but you're not going to buy all of those liens. There's just not enough of them out there being sold at that mid upper teen level. So now your expectation is, well, do I have a clean portfolio, right? Limiting those massive losses, right? Those headaches. So if it's easier to get rid of anything that smells fishy, right? And just not go there, because one bad one can dilute the return from a whole lot of good ones in the lean space. And so you got to clean what they call a clean portfolio, not a whole lot of those issues. And if you can manage those with the minimal overhead, right, and maximize the difference between whatever your cost of capital is and what that return that you're going to get at the end of the day, you've got a winning model, right? Too many times people get excited and they're like, wow, I'll just be a little more competitive to grow my portfolio. And now you've got a $50 million that's making essentially net 0.1% or zero. There's probably a lot of other ways you could spend that money or spend your time making more than just managing a large lean portfolio in that scenario. So those are kind of two ends of the spectrum, and then obviously there's everything in the middle, depending on what you want to do. But your expectations should match the volume you wish to place.
Well, I think some folks that are listening to the podcast are saying, "Wow, this sounds a little bit like the the wild, wild west." What kind of market, regulatory, or legal changes and challenges are having the greatest impacts on the tax sale industry today?
That's an excellent question, right? From a regulatory standpoint, it's an unregulated space. You don't need to have a certain, granted, I have my certification. You don't have to have one. Anybody with an EIN can go sign up and buy these, right? If you have cash, you just sign up these days, right, on the website, register, put your deposit in, and start buying, right? It's a very easy thing to do. Now, there certainly are changes, right? And there's been more changes in the last 5 years than the previous 20, like that I'm aware of, and really resulting from a couple Supreme Court cases that came about. We don't have to go into the details of those, but the reality is, it's not as unknown of a space as it was 10, 15 years ago, and there was a lot of gray area, right, where the statutes didn't quite define what you should or shouldn't do, or how do you calculate your interest rate, or how the sale is supposed to be conducted. And there are ways of I'll say gaming the system, right? But the Supreme Court and the cases that involved in those have done a good job of leveling that to be something that should be fair across the board. Fair for investors, fair for property owners, fair for counties, right? And not trying to favor any one of those. So there's definitely been a lot of massive evolution in the last 5 years due to those couple of Supreme Court cases. One as recently as a couple of months ago is Pung versus Isabella. Now, on top of that, right, nobody likes taxes. Nobody likes property taxes, right? And you had a giant skyrocket in values through the pandemic. And so you see property tax bills skyrocket, right? And so you have something nobody likes, and then now it's a larger bill, in some cases twice as large as it was a few years ago. So property taxes in general are under fire more than I've ever experienced. And there actually is 3 different states today where there is legislation out there to eliminate property taxes entirely. Now, at the heart of it, that is the primary revenue driving counties and driving townships, right? Paying the police, paying the teachers, paving the roads, right? That is how most areas function. And so without some sort of replacement for property taxes, you're not just going to eliminate it and then the cost not be there in some other way, right? It's going to be there in an extremely high, sales tax or whatever that solution might be. So I don't know that there will be an actual elimination of property taxes, but just goes to show enough people don't like what's happening enough to even make it on the ballot, which is scary to some investors that rely on this as their livelihood. I honestly don't see that going down, right? I don't see that attack ever subsiding. And if they ever do figure out a alternate solution to property taxes, I'm sure it'll be implemented. But the fact that it is governed state by state, every state gets to make that decision.
So right here in Florida, we have a constitutional amendment coming up in November of 2026
You got it.
to significant, not eliminate, but to significantly reduce property taxes, to your point. Well, for an accredited investor or a fund manager considering this asset class, what should they look for when evaluating an operator or an investment partner?
Yeah, I think the number one thing is look for somebody that's been in the space for a long time. It is a space that is almost impossible to learn all of the ways that you can get burned without actually learning that lesson the hard way. And you're not going to find anybody, a teacher out there that's going to, or a class, right, at a school that's going to say, here's all the ways you're going to lose your money, buying these. And so as a fund manager, you learn those along the way. Trust me, we've learned many of those, right? And I've been in this space and I'm still learning those. So, I think the number one thing is just find those that have that proven record, that have been in the space, working their model, and they know what they're doing, right? They're not going to be perfect, but at least they've learned some of those hard lessons over the years and they've built the processes in place to help avoid those scenarios. And so they're not going to go buy a bunch of liens that look great. And then at the end of the day, they're not enforceable and it all gets wasted. We've seen that happen.
Yeah.
And so look for those that have been doing it a while.
So Brian, last question. What didn't I ask that I should have asked that you want to share with our listeners?
Well, I think I don't know if it's a question, Ray, but I think I spent a lot of time talking about like the difficulties of the space, right? And it is difficult, but it can also be a very good risk-adjusted return, meaning it's counter-cyclical, right? Typically when the economy's in the tanks is when this space is booming, right? And so if you're looking for something to help offset whatever your investments may be, and if you think we're headed into a recession, tax liens can be a great place to park your capital and to continue making a good return in that cycle. And it is, at least in my viewpoint, there's a lot of good feelings around helping the communities that you are investing in, whether it's through helping the counties balance their budget so they can pay their teachers, right? Whether it's buying that crappy house on the corner and turning it into the nicest house in the street and ultimately raising the values. And so there's a lot of gratification involved in this space beyond just the return profile. And I think that's kind of an overlooked aspect of the space that we're in. And it's not, I think the media in general likes stories that are scary. And I think a lot of people have this misconception that, the tax sale space is a bunch of, money hungry, people that are taking advantage of folks that are, hard on their times. And in reality, that is not, right? I guess I've met some of the greatest people in the world that are involved in this space. And there certainly are bad actors out there, right? But they're like anything, right? They're by far the minimum. They're not doing good things. Could the space benefit from a little more regulation and oversight? Yes, right, to keep those things from happening. But it is a space that overall is doing good in the country.
Well, Brian, thanks a lot. It's been fascinating chatting with you today, learning a little bit more about the tax liens, tax deeds, foreclosure on the property, et cetera. And why don't you tell our listeners one more time, if they're interested in following up, what's your website once again?
Well, go to taxsaleresources.com. That's probably the easiest thing to do. There's a lot of information on there for free if you want to reach out. We do utilize AI, but one thing we don't use AI for is customer service. If you want to give us a call, there's going to be a real person on the other end to answer that. And if, whether you want to talk to me or just learn about the space, give us a call.
Great. Thanks again. Appreciate it very much. Now to all of you, go out there and up your assets.
This has been another edition of the Up Your Assets podcast hosted by Ray Ferrara, CFP founder and executive chair of Provise Management Group, LLC. The preceding presentation was for general information purposes only and not personalized advice. Seek out a professional before making any financial decisions. Additionally, no guests pay to be on the show or are paid to be on the show. The opinions expressed are their own and not the host's or the show.